So, look, as it relates to politics, things ebb and flow. I think New York in particular and San Francisco have some amazing things going on in these cities. And in the world of globalization and technology, these places I think will continue to do very well. So at times, are there policies that could get put in place, and we've seen it in the past, that could impact values, job creation, and other things, hotel taxes, other things that can really inhibit business? Yes, but I think a lot of political leaders today, even at different ends of the spectrum, I think recognize that, you know, safety of the citizens, a good business environment is helpful for everybody. You know, I can understand people saying in a town like New York, a lot of the benefits have accrued to a smaller number of people, and we want to find a way to make it a little broader. So I would say overall, places like New York and San Francisco, we have a long-term bullish view. I think demand for space in these cities will continue for a long time. I think the quality of life will continue to get better. And they're hard places to build, and that's good for existing real estate.
As a contrarian investor, when you look to Europe and Asia, where in the risk profile are you comfortable when you look at Europe? I mean, whether you look at Greece and Portugal at the bottom, and Spain in the middle, and Germany and London at the top. London doesn't really have the stress. It doesn't mean it's not a market you would invest in. But so, where do you go in the risk profile when you're looking to invest in a place like Europe or Asia?
So, like everywhere in the world, we're trying to buy hard assets at discounts to replacement cost. And if I look at Europe overall today, the negative on Europe is growth is, you know, facing some serious challenges. And that's a result of their banking system needing to shrink, and some of the challenges in their monetary and fiscal union. And so we believe that growth in Europe will be slow for an extended period of time. So our bullishness around Europe, we put out $6 billion plus of capital, of equity capital in Europe the last couple of years, is not because of an overly optimistic view on European growth. It's because the distress again, like the U.S. a couple of years ago, is creating an opportunity to buy hard assets at attractive prices. So we bought a number of hotels in Ireland from banks, prices down 70% from where they were back in 2007. We bought office buildings recently in Italy down about 50% from where they were back in 2007. We're buying apartments in Spain down roughly the same percentages. And this is because there's not a lot of debt capital, particularly as you move towards the continent, and the economic environment is weak, and investors are rightfully nervous. But we look at it and say, if we can buy high-quality real estate at these kind of prices, we have to believe relatively little. And that's what gives us confidence. Now, there is risk in places like Spain and Italy. If you buy debt, it's not the same as Germany or the UK in terms of foreclosing and what rights you have as a lender, and you've got to price that in. But we're of a view that Europe is a major part of the global economy. It may not grow as fast, but it'll still be around. And hard assets have value. There's need for shopping centers, warehouses, office buildings, apartments, you name it. And if you can take advantage of the fact that capital isn't there today, then it's probably a pretty good time to deploy capital.
What keeps you up at night?
In Europe or around the world?
Just in general.
So, you know, it's funny. The question we haven't talked about that everybody's worried about on real estate is rising interest rates, which I think are obviously impactful, and certainly if they go up dramatically, very high levels can have a significant impact on real estate. However, I think people focus too much on the fixed income nature of real estate, and they don't focus on the cash flow. And so if interest rates go up, and it's coincident with economic growth, real estate can perform fine. In fact, if you look back in the early 90s cycle of rising rates, late 90s, mid-2000s, commercial real estate went up in both private and public markets because underlying fundamentals of the properties got better. And particularly in the current environment where supply is down so dramatically, many parts of real estate down 60, 70%, that leads you to believe that economic growth could lead to some healthier cash flow growth. So, ironically, I'm not as nervous as most folks are, I'd say, about rising interest rates. The things we watch for are twofold. One, we watch for an excess of capital and an excess of cranes. I mean by capital is when the banks start lending, if you go back to the '07 period, 90+% at low spreads. You know, back when we sold $60 billion of property, '05, '07, that makes you nervous. That's one thing. I don't see that in almost any market around the world today. Second thing is when the cranes are out in force. And if you look across the U.S. today, if you look across Europe, you look across Asia, maybe condominiums in Toronto or everything in Riyadh, there are a few markets where you see a lot of cranes, but for the most part you don't. So that generally makes us constructive towards real estate. In the near term, what makes me nervous, you know, bombs going off, earthquakes, terrorism, all those things impact our business. And one of the challenges of owning things around the world is every day something can go wrong somewhere. So that's part of the business. But longer term, as real estate investors, watch out for building, watch out for too much leverage.
So